Hey guys, what's happening? It's good to be back for another live stream tonight. Looking forward to tonight. I think we're going to have a good time on the broadcast here. There's a lot going on. As you know, Mr. Trump is in his sixth week, and I heard on the news tonight that things are moving so fast that not even the media can keep up with it. So, I don't know that we can either, but at least maybe we can catch little tidbits here and there. But tonight's topic is going to be kind of fun. It's going to be called shareholder buyback. So if you're not familiar with that, hang tight because we're going to talk about what that means and whether it matters for us as dividend investors. You could be called a dividend investor, dividend growth investor. Um, that's what I consider myself. I typically don't invest in companies that do not pay a dividend, and it's not that I seek dividend income. I don't really even measure my dividend income, but what it does, the companies that pay dividends are able to grow those dividends or not, right? They will sometimes decrease dividends, hold them the same. But what they're looking at when they are paying dividends is their long-term forecast. And they don't always get it right. And but what it does is it kind of gives us a sense for what they as the company are seeing in the long run. It's a little piece of information that you don't get with companies that don't pay dividends. And so that's kind of why I like doing that. It gives me a little bit of a window inside what the board and the management team sees in the long term forecasts for their company. So that's why I'm a dividend growth investor. I think this just a just a little bit more information than you would get somewhere else. So, do I have mic problems? Let me see. Can you hear me? Hold on a sec. Let me check something because no, it should be good. Yeah, I should be rocking, man. Huh. So all of you guys are saying that. So it must be picking up off of my computer, and I would understand why that is because of the way I came into the program tonight. But let me try something quick. Does that help at all? Test, test, test. Is that helping, guys? Give me some feedback. If it sounds like I'm in a tunnel, it's probably because my laptop mic is picking up. Oh, good. So that's helping. I see a better and a yes. It's fixed. Fantastic. Yeah, when I turned my computer on, I had here. I'll show you. This is it's a Yeti Nano that I use, and you see this green light that's on here. Let me get my finger there. There's a little green light there, and when even when the computer's off, that little light's on, and I just think it's just going to wear my mic out. So I end up unplugging it. It's a USB connection. I unplug it. Well, when I was getting into the what is this called, StreamYard tonight to get the live broadcast going, I forgot that I had not plugged it in. So I plugged it in, but I think it was too late. And even though it was telling me it was on the right mic, I don't think it was able to make the switch. So I just went in and manually did it. And I appreciate you guys letting me know that because otherwise it would have sounded like I was in a hole. And that's no good. So anyway, we're going to talk about the buyback formula tonight. So let's see who all's on the show tonight. We got 12 people, but that's 12 awesome people, by the way. So we got Shannon. Shannon's good to see you, my friend. Pat. Let's see. It's are you back in Minnesota? I think you are. So good evening to you. Let's see. Rust Moments. He says, I got the wrong mic, and you were correct, my friend. And I'm going to skip through all of these mic check. Let's see. John J. No, your mic is not working. Good. I appreciate that. I think it's back now. Let's see here. All right. Yeah. So now John says it's great now. Bernard is on the program tonight. It's good to see you, Bernard. And Legendary. Good deal. You made it in. It's been a while, but, I appreciate you showing up, my friend. We're going to have a good time tonight. So, Rust Moments loves buybacks, and there was some discussion on the Discord this morning about buyback yield, and that's why I thought it'd be a good idea to talk about that on the program tonight. It was just one of those things where I was like, that's something that we just don't talk a lot about. And so what do dividend investors think? What is it? How do we use it? Does it matter? So we'll talk through some of that tonight. Arguably better than dividends since it's non-taxable. That is correct. Well, I would say it is tax deferred. And the reason I say that is because it grows the value of the stock because there's fewer shares and you got the same company. And so if those shares are more valuable, the share price will reflect that. At least at some point, it will reflect that. And therefore, that capital gain would be captured when we sell those shares. So I know that's technical and that's like nerdy, geeky kind of stuff, but I would say it's not taxable in the period until we recognize it, and then it's taxable. So, all right. Pat says yes, he's back in the UP, Upper Peninsula of Michigan. So John Jay wants to know what have been my thoughts about Buffett sitting on a pile of cash. Well, I think based on what the market has done here over the last week or two, it's probably pretty bright, probably pretty brilliant, right? Sometimes, you take a gamble and it works. I think maybe this has worked for him. I tend not to like that approach because I am not very good at timing the market. And I don't know many people that are. Maybe they've got all these, smart people that work with him. But I might know when to get out, but I have a really hard time knowing when to get back in. And so I don't like to time it. I have sold some things this week, or I guess last week. It's Monday. So last week I sold a couple of positions, and I had 26 positions starting the week last week. I ended up with 24, but I turned around and reinvested, some portion of that into companies that I already own. So while I do have a little bit bigger cash position than I had last week, it's still about 3%. Let me see. Let me just make sure. Check it out. Yeah, 3.3% of the portfolio. And it's not a ton, right? That means I'm 96.7% invested in the market. But I do have a little bit of cash sitting there just in case something craps the bed. And maybe we'll talk about what I'm looking at a little later in the program. What are the top things on my list? So hopefully that'll be kind of fun. So what do I think about Buffett sitting on a pile of cash? I think it's probably been a great move for him. I don't know that I would trust myself to make that move. I just don't know when I would get back in. And then I would miss the upside, right? So I just kind of ride it like a roller coaster. I don't hardly ever get off. Let's see. Russ says he looks for stocks doing dividends and buybacks. EOG is a very shareholder-friendly company. Yes, they are. So we'll talk about that here in a couple of minutes. Let's see. Is there anything else we need to do before we get started? I don't think so. So let's get started with shareholder buybacks. We will get this off the screen and put that on the screen. Let me shrink this down so that it's a little bigger for you guys anyway. So shareholder buyback yield, is that important for dividend investors? So let's take a look at what it is. Shareholder buyback yield is actually calculated by taking the share repurchases, and this is not the number of shares, it is the dollar amount that the company uses to buy back shares. So let me back up for a second, because there is this, there's this thought out in dividend land that companies make money when their stock price goes up and they lose money when it goes down. The way it works is that a company will issue shares to be sold in the public market. Those shares are actually bought by these companies like Goldman Sachs and those kind of companies, who then turn around and sell them to the public. So it doesn't necessarily have to be an initial public offering. It can be, just additional shares over time. They will issue those out. That is when the company receives money for those shares. So if the stock price is $35 and they get $35 for the shares they issued, that's the capital that they get to invest in equipment, to invest in their business, to invest in their strategy, in their people, whatever, right? If that stock then goes up to $50, guess who wins? The person who bought the shares, and that's people like me and you are winning when the company does better. So those shares, the company doesn't get really any value from that, other than just growing the business. So they, if the company is doing very well, they've got some excess cash. One of the things they could do instead of issuing shares is buying back shares. And what that means is they will actually take money, a check, and write that check to the market or to some broker somewhere and say, I want to buy back X amount of my shares. And maybe that's, 100 million, let's say. They'll say, I want to buy back $100 million worth of shares. That company will go out and will actually do that purchase. And then those shares are collected. They are assigned to the company who actually is the company. And they will retire those shares. And what happens then is that the company is owned by fewer shareholders, which means each shareholder has a little bit bigger slice of the pie. So it's actually a very good thing for companies to do buybacks. But I wanted to point out that the share repurchases that the company does are on the open market. It's not that they have any kind of inside track or they get it special pricing. It is on the open market. So those share repurchases then are divided by the market capitalization, which is the number of outstanding shares divided by times the price per share. And that's really what the equity of the company is worth. If you wanted the total value of the company, the enterprise value, the EV as they call it, you would not only have the market cap, but you would also add the debt to it, and that would be roughly the enterprise value. All right, so there's the formula. That's the geeky part, and that's where folks like me have a lot of fun. But what does it mean? One of the things that this means for us is it's one of the ways that a company can allocate capital. So when we talk about capital allocation, we're talking about how does a company take the excess capital, cash, whatever you want to call it, from the business, from what the business makes. Let's say the operating cash. How do they allocate this operating cash after all their expenses are paid? How do they use that? Do they grow the business with it? Do they give it back to shareholders? That's capital allocation. There's really 5 main ways. There's probably more. Maybe you guys can think of some ways and throw it out at me there in the comments. But one of the ways is capital expenditures. So if you were to take the operating cash flow of the business minus capital expenditures, you get one of our favorite metrics, which is called free cash flow. It basically says that if the company is going to, buy new equipment, buy a building, trucks, whatever it takes to run their business, that's a capital expenditure. They are, investing in the business, and anything other than that is what we call free cash flow. Number two, they can use it for mergers and acquisitions. And there's not a lot of companies, maybe Microsoft might be able to finance mergers and acquisitions out of cash. Some companies issue shares, some companies borrow debt, some companies do both, some companies do all three. But mergers and acquisitions is another way of allocating capital. Number three is debt repayment. And this is probably the one that investors really don't see, other than it makes the company more solvent. It makes the company more, it gives them a better balance sheet, right? And so they can pay their debt service a lot better. So debt repayment is a good way to allocate capital. Number four is dividends. That's what we like to see as dividend investors. We like to see dividends. And number five is share buybacks. So it takes cash to buy back shares, and that's a capital allocation. So the total shareholder yield, you have dividend yield, which is one of the things that we like to talk about, which is dividends per share divided by the share price. But you also have the buyback yield, which is the share repurchases divided by the market cap. If you add both of those together, you get total shareholder yield. I thought it'd be kind of fun to give some examples of this. And I will tell you guys that I normally don't look at this because it was a little difficult to calculate, right? Because you have to go to the 10K, 10Q somewhere and find what the share buybacks were, and then divide that by the market cap and go find that number. I didn't really know that I had an app that calculates it for me, and that is Morningstar. If you're a subscriber to the Morningstar, I don't have an affiliate arrangement with them, but I do use them as an app, and they have a field in their database that is called buyback yield. So let me show that. Oh, you're already seeing it. So you can see here we have Apple, AbbVie, Accenture. So I track on a weekly basis of roughly 100 stocks. It's 101, I think. And so what I did is I just went and pulled from Morningstar's app the buyback yield, the dividend yield, the forward dividend yield, and added those two together and got the total shareholder yield for those 101 stocks. So I thought that'd be kind of fun to look at. So you can see here, for instance, Air Products has not recently bought any shares back. They have a dividend yield of 2.26, so therefore their total shareholder yield is 2.26. However, if we look at Apple Inc. has a buyback yield of 2.71%. Their dividend yield is only 0.41, but the total shareholder yield is 3.12. So they're basically giving shareholders money back through buybacks as well as through dividends. And so that gives you the total. And as Rust Moments, he's got a couple of different names that he goes by. So Russ Moments pointed out that there is a tax difference if you're in the U.S. Between these two. The dividend yield, if it's a qualified dividend, then it's going to be taxed at the capital gains rate. If the company does a buyback and you hold those shares and the share price goes up because there's fewer shares but the same amount of company, right? So you get a bigger slice of the company, then you don't really pay tax on that until you actually sell it and get that capital gain from it. So so let's take a look. I thought it'd be kind of fun if we sorted this column I'm going to sort this column in descending order. The largest total shareholder yield in the 101 companies that I'm following is Carlyle Companies, Inc. I want to talk about Carlyle because I may be buying some shares of Carlyle here before too long. But their buyback yield is 10.44%. That is huge. They are a huge buyer of shares. And I tell you what, let me pull this over here. I know that's exciting for you guys, but let's pull up Carlyle CSL. And you'll see that their dividend safety is 99. I do not own shares of Carlyle at this moment, but I am really considering it. Their dividend yield's only 1.2%. They've got a dividend growth of 18%. Let me say this before we go any further. I know this is kind of geeky, but when a company grows its dividend and they're doing huge share buybacks, they have the ability, because they're buying back shares, they're no longer paying dividends on the shares that they have bought back, because it would not make sense for the company to pay dividends to themselves, right? So once they retire those shares, they no longer have that dividend obligation from a cash perspective, so they can actually raise the dividend for all the other shareholders and not even change the amount of cash paid for dividends. So it's a beautiful thing. You can see Carlyle is taking advantage of this. They're buying back a lot of shares. They're growing their dividend really fast because they've got the cash to do it, because it really doesn't change the cash really all that much. Their credit rating is BBB, which is fine. Let's see what else is kind of fun here. So if you don't know what they do, they are I like the way they put this. They focus on products that protect buildings from water and air damage. So that's like roofing, insulation, waterproofing, things like that. So it's really in the construction industry. And so they're really taking a hit here lately. I say they've taken a hit. They're really more at fair value. They typically run above fair value. So might be a decent time. But I mean, looking at some of the numbers here, their latest was 18%. The last 5 years, they've been growing their dividend by an average of 16% per year. That's huge. They got a dividend growth streak of 48 years. Let's see what else we got going on here. This says they may be undervalued. I don't put a lot of weight in this valuation metric that Simply Safe Dividends has, but they say it may be undervalued, so that's cool. Let's look at some of the financial numbers. This payout ratio is in the high teens, low 20s, so that's phenomenal. Anything below 60 is awesome, so 20% is fantastic. I like that. What else do I like? Take a look at these shares outstanding. See if I can. No, I can't make it work. But over the last 10 years, they have dropped almost 20 million shares out of 65 million. So that's I don't know what percentage that is, but it's pretty good. It's like 30% maybe. So that's a lot of buybacks going on with Carlyle. Return on invested capital is sitting around in the mid 20s. Fantastic. What else should we? Interest coverage is 15.27. Anything above 8, we like. So there's a lot to like about Carlyle. And before I go really too much further into that, I'll just tell you that I'm really looking hard at buying Carlyle. They've gone down today 2.3%. And I don't want to catch a falling rock, but I also know that they are a solid company, that they're just getting caught up in tariffs and the fear around all of that. So that's my take anyway. Let's go back to this. So you see Carlisle, top total shareholder yield, at least in my model. Altria Group is high as well. They're benefited by the high dividend yield, but also they have a 3.6 buyback yield. Comcast is pretty high as well. It's on my list, but I don't really like the strategy of Comcast, so I tend to stay away from it. Chevron is big as well, almost 10%. See if there's any others. So Whirlpool is benefited by the high dividend yield that they have. And then, as Russ Moments mentioned, EOG Resources, they've got about a 4.6% buyback yield and a 3.1% dividend yield. So about 7.7% in total shareholder yield. So that's pretty reasonable, I think. So you can see that, it changes the picture a lot for some of these companies, like Goldman Sachs, for instance. They've got a buyback yield of 4.1%, dividend yield of 1.9. So if you look at the 1.9, you go, oh, they're not really paying much to the shareholders. But if you look at the total, 6%, that's pretty reasonable, I think. So you can see, I'll kind of scroll down through here and let you see these companies. They're in descending order. So like, for instance, McDonald's, not very big, 3.5% maybe. Who else do we want to look at? Here's Visa, 3.1%. Who's the worst? The worst is Badger Meter. They have no buybacks, and they only have a 0.65% dividend yield. Comfort Systems, 0.45, 0.44, so 0.9 total. Eli Lilly is also pretty low. So you can see these. I don't have to read them to you, and Parker Hannifin is pretty low as well. But I really like Parker Hannifin. Amphenol is low in the total shareholder yield also. So anyway, hopefully that was helpful. Those are some examples. And what's cool is there is a place that you can go and actually get this data as long as you have a paid subscription to Morningstar. So just thought I'd let you know that is out there. And I was surprised to see that today. Let's see. Where are we at here? Okay, EOG. John Jay wants to look at EOG. So we can do that. We have the capability. We can build that. Let me come back to this. I'll take that off the screen and we'll just take a look at EOG. So just real quick, let's flip back to our sheet here. I'll sort this here like that. EOG is 7.7% roughly, 4.6% shareholder buybacks, about 3.1% in dividend yield. So let's take a look at some of their financials, because I think that's really what you're asking about. Here, there we go. So EOG, while their yield now is, they were down 5% today. So the yields now, I pulled the yield this morning, so you can see the yield's a little bit better today because it went down 5% than it was even this morning. Credit rating of A minus, very strong, or strong A minus, so that's good. Let's see what else is going for EOG. Now EOG historically paid a special dividend, and they have now changed that, and I think they're using it all for share buybacks. So I think that's actually a pretty good move for them. But they've been growing their dividend pretty fast. The latest was 7.1%, but over the last 5 years, it's 28%. So that's pretty smoking fast. Let's see if there's anything else that's cool. Earnings payout ratios in the mid 30s. Can't beat that. I guess you could, but it's decent. Yeah, Yeah, they don't. Here recently they bought back probably 15 million shares. So that's a pretty decent amount of share buybacks. But again, they used to give special dividends. They now are buying back shares with those special dividends. So I think you're going to see this improve over time. Return on invested capital is around 20%. It's been 25, 28. So, pretty decent. And their interest coverage is about 59. So they are in good shape. So I own EOG. That's one of the companies I own. And I think I'm just going to hold it like forever unless something happens. So, yeah, I kind of like them. What else do we got here? Fast Eddie is in the house. Welcome, man. Good to have you on the program. Yeah, CSL is amazing, or Carlisle is amazing. Rust, and I think I'm actually going to start a position in Carlisle. They have typically been overvalued from my perspective, so I have not bought them, but they're in the fair value range, so I think that's good stuff. So, Carlisle's your largest holding. That's fantastic. Hey, Billy, welcome to the program, all the way from the Philippines. At least I think you're back in the Philippines now. Wow, Russ says the EOG bought back $1 billion of stock this quarter. Wow. Shannon wants to know, what do you think about TSMC investing in Arizona, $100 billion investment? I think that's a really smart move for TSMC. I was surprised. I thought they had already had an investment in Arizona. Maybe they're adding to that investment. I thought that TSMC as well as Intel were kind of racing to see who could get done the fastest in Arizona. And but maybe I could have been wrong. I don't know. I don't own either one of them. But I think it's a great move for TSMC. I think it opens them up for, in this world of America first. I think it opens them up to be able to, take advantage of that. And now, they got to move fast because they could be left behind. But like I said, I thought they had already begun investing in that Phoenix area. So I'm not sure why I thought that. Oh, I see. Yeah, good deal. So Shannon has helped me out and said they had 65 billion, but they added another 100 billion. So I think that's fantastic. I think it's a huge move for them. They do have a lot of risk sitting right offshore of China there in Taiwan. I think that especially if America is in a weak position, that it puts them at a lot of risk. And I think they're the premier chip builder, chip maker in the world. So they got a lot going for them, and I would hate to see the geopolitical tensions of China, Taiwan, U.S., Russia, all of that stuff. I'd hate to see that kind of hold them back. Yeah, Michael Anthony, welcome to the program, man. He says, I knew Friday was a dead cat bounce, but the selling on the QQQ, twice the 300 gain on Friday is crazy. Yeah, I don't know if it was a dead cat bounce. It looks like one. I think it was really related to the opening of new tariffs in Canada, Mexico, and I thought there was one other. I don't remember. So once those tariffs were announced, because if you recall, about a month or so ago, it was like, Trump said that, hey, we're going to do tariffs, and then they kind of walked them back as they got some concessions from Canada and Mexico. So today there was an announcement that as of midnight tonight, tariffs start for Mexico as well as Canada, that tends to cause some, I don't know, some panic. Is that the right way to say it? Fear, maybe, in the market. And I think now's a great time to take advantage of that fear. I think finding good quality companies that are being impacted by this fear that's in the market is not a bad way to take advantage of it. So, like, Carlisle. So here in a few minutes, I will take you to my spreadsheet and I'll show you the top stocks that I'm looking at for this week. Yeah, so Michael says, does all the data in the past few weeks pointing to a recession? I don't know. I haven't seen anything that says, we're going into a recession, but could be. I don't know. It could be tariffs drive that. I don't know. I don't. We're kind of in uncharted territory because we haven't done tariffs in probably 100 years, and so we're going to see. We'll see how this works. Hopefully they've got their hand on the throttle of the airplane, and they're going to keep the throttle at the right spot. So, my buddy Russ, welcome to the program, my friend. Did you cover any drawbacks to shareholder yield? They don't account for overpaying for buybacks, which could destroy shareholder value, right? Yeah, so that's a great point, Russ. And so one of the things that we like as dividend investors, we like for companies to be buying back their shares when they are undervalued, when they're getting more value by buying the share than they believe the company is worth. So the difficult thing about that is knowing what the true value of the company is, right? So, folks like Carlisle have been buying back shares like crazy, but they've been overvalued, right? And so is that really eroding shareholder value? I'm not really sure. I think as long as they grow the company, it might stunt the growth a little bit, because they're using the cash to buy back shares at a higher price. I don't know. What do you guys think? Does buying back shares when the share price is at a premium, does that erode shareholder value? I would say it probably does. And so, but I also understand the challenge that companies have, right? And that is usually when their stock price is high, it's when the company is doing well. When the company does well, it has free cash to allocate to capital sources like buying back shares. When the company is performing poorly, either it's the economy or something happened, they tend to not have the cash to do it. So there's this dichotomy, there's this challenge that companies have, that when they have excess cash, their stock price typically is higher. When they have little cash and they're borrowing money, their stock price is typically lower, and they can't really afford to buy the shares back. So, there is a downside to that, although I don't think companies and management teams have a great deal of ability to make those calls perfectly. So hopefully that makes sense. I don't know. Those are my thoughts on it. Let's see. Buying Pfizer could be the best with a 0.43 dividend and PE drop from 39 to 18. Which earnings getting better? Which drugs approve and see $40 coming later? Yeah. I don't know, man. I'm not a huge fan of Pfizer. I would much rather see people investing in Merck, but I think there's only one drug company that I invest in, and that's Johnson and Johnson. So it's kind of like a crapshoot to me. And typically the way they grow their pipeline is to buy another company that has a pipeline. So, we'll just have to see. But, I don't know. Just because Pfizer now is at an 18 PE doesn't mean it's going to turn back and go to 40. There's got to be some catalyst to that. And maybe there is. Maybe there's some drug that's like, going to really knock the socks off of people. Is that the way to say that? Maybe that's not a good way to say that. Because if you had a drug that knocked your socks off, that means it really knocked you out. But anyway, you know what I mean. So Russ says, I could see that and could see a company doing an unfortunate timing buybacks. Yeah, exactly. But at the end of the day, the total shares are down. Exactly. So are they paying too much for the shares? And if they are, but yet long term, the shares are going to grow, can they really pay too much for those shares? Here, let me give you an example. Let's look at, I'm just going to pull up, who can we use? Looking for just a regular Joe Blow company. Let's take PepsiCo. I don't own PepsiCo, but we will take PepsiCo. I'm going to clean this up a little bit before I put it on the screen, just so that you're not looking at craziness. Yeah, there's just a bunch of stuff here. So here, I'll put this on the screen now. All right, this is PepsiCo. This is the max. It's probably a 20-year look at their share price. So let's say that in 2007, let's pick 2007. You can see that, I think. There's here, let me make this a little bit bigger. Can you guys see 2007 here? The share price was around $78. Let's say that Pepsi was buying back shares at $78, 23 times their earnings. It's really at the highest point since, early 2000s. And then anytime really until after 2012 or 2012. Yeah, 2012. But you can see, $78 a share, maybe it would have been a bad deal at that particular point in time for Pepsi to be buying back shares. Especially with it going down through the financial crisis of 2008, 9, 10, and the the period we will never get back, which is through 13. So if they bought back shares here in 2007, it looks bad, right? It looks like they didn't do a very good job. But I think they are glad if they bought back shares in 2007. I think they're pretty glad about that now with their shares trading at around $156, right? So I think if you look at it from a long-term perspective, yeah, they're overpaying. But if you believe in the company and if they believe that the value of the company is going to grow over time, then, if they can find a cheaper price, then that's the way to do it. But it sometimes is not a bad move, even if they're paying more than market value, more than what the intrinsic value is of the company. So anyway, just a thought. Here, let me get this off the screen. I got too many things going on. All right, here we go. My buddy Russ here says, Warren Buffett says it destroys value, but intrinsic value is very subjective. And if cash flow keeps growing, yeah, exactly. That's exactly what I was saying, Russ, is that as the value of the company grows, and as you say, intrinsic value is hard to nail down because we don't know the future. We know what we think intrinsic value is, but we also know that over time, companies are going to grow. At least the companies that we want to invest in are the ones who are growing over time. If those companies grow over the long term, now might be the best time to buy these shares back. So, I mean, I just picked a random company, which was Pepsi. We could do this, all night, but, cyclical companies I can see, so if you're buying into a company like Caterpillar, Cummins, and buying those shares back at the peak of a cycle is probably not a good move. But companies like Johnson & Johnson, PepsiCo, where they're buying back shares that are going to continually grow over time, it'll be hard to argue that that's a bad move, regardless of how many shares they buy back. Drinking a little unsweetened iced tea tonight, so I'm not sure even who makes this. And it's probably not worth me trying to find it on this bottle. Yeah, it didn't say. If it does, I can't find it. So, independent producers for Pepsi. So here you go. Pepsi got mentioned in the broadcast as well as in the props. All right. So EOG bought 1/70th of their value. Yeah, I'm not sure. I'd have to look at the numbers. Yeah, he was asking somebody else anyway. That's good. 1.3% of the company. All right. John J. wants to know, companies buying back their shares, is that also sometimes to prop up the share values if he's dropping too much? Yeah, I mean, that's certainly a way to do that. It's so you can, if you're a leader of a company, you can do a lot of things, right? You can invest in companies, you can invest in equipment, you can invest and grow your business. And if your business grows and there's more value in the business, then the share price will grow. Another way to do it is to buy back shares and have those shares represent a bigger slice of the pie of the company. That drives shareholder value, as they call it. And so that's one thing you can do as well. So if you're wanting to prop up the stock price, I'm not sure that's a great plan. I know some companies probably do that. If you're wanting to use that as a way to grow shareholder value, I think it makes a lot of sense. So, but yeah, some companies, they can do that. They can, if the stock is dropping like a rock, might be a great time for them to go in and buy a few shares. Because it's a equilibrium thing. So yeah, so Michael, I don't play around with Bitcoin or any kind of crypto at all, so I don't even watch it. So Bitcoin jumped on Trump news over the weekend. 70,000. Yeah, I don't know, man. So I'm not a huge Bitcoin fan. I don't think there's any value to Bitcoin. I think the only value is what gets driven by people who want to buy it. It intrinsically doesn't have any value. So what makes it valuable is that somebody else wants to buy it. As soon as that dries up, that value's gone. I think we saw that about a year or two ago. But and now everybody wants to buy it. But it's just because of people wanting to buy it that it has value. So that doesn't really it doesn't excite me at all. I'm not saying it's a bad investment. I don't even know. I don't play enough with it to know. A company could issue debt just to buy back stock. That is correct. And some do. Monster Beverage just did that. I don't like that. So you always got to check the bigger picture. Yeah, exactly. So you always want to check the balance sheet. You want to check their debt service and what their debt is as a percentage of total capital. So it's really about doing your due diligence, right? You want to look at the entire financial picture of the company, not just the buyback yield, not just the dividend yield, not even just the PE ratio. Anyway, I don't want to go off on that rabbit trail. Oh, this is good to know. Pepsi and Unilever Is it Unilever or Unilever? I don't know. Unilever, I'll say. Joint owned Pure Leaf, doing a quick Google search. That's good to know. So we got two companies that are teaming up to allow me to drink a little unsweetened tea. Something that I probably paid way too much for, because I could go get a tea bag and make this probably for pennies. But anyway, sometimes you just got to pay for convenience, you know? Just didn't have time to make any tea tonight. All right, so where do we want to go from here? I wanted to show you guys how much time we got left. We got just a few minutes left. I wanted to show you guys what I'm looking at from, let me find it. Here we go. Okay, my top stocks that are on my buy list. I think I'm going to just narrow it down to that. I'll show you what those are here. Let me get Rust off the screen. You guys want to see what's on my list? I'll make it bigger so you can see it. So my number one is ConocoPhillips. It dropped a lot today. I think it dropped, let's see. Yeah, like 6.58% dropped today. That wasn't my fear. That's why I didn't jump too quickly in there, although I did buy some last week. Wish I had waited till this week. But again, I'm not very good at timing the market. But I do know there's some value in ConocoPhillips, so I may take a look at adding some at this point. Amphenol, also a stock that is really getting hammered with these tariffs. And then guess what? Guess who has jumped back up in the number 3 spot is Google. So, they're sitting at 4.3% of the portfolio. They've worked their way back up. And then we have United Health, Carlisle. Now, Northrop Grumman is kind of interesting because I don't own either Carlisle or Northrop Grumman. But if we take a look at what Northrop Grumman did today, while everybody else was down, Northrop Grumman was up almost 3%. And, you have these audits that are going, and you have this Doge, and what are they going to do with the defense companies and, stuff like that. So not really sure what's going to happen there. But I do think that of the defense companies, if I were to put one more dollar into defense, it would be Northrop Grumman. That would be the company that I would invest in. Microsoft is still on the list as a buy. Elevance Health, Realty Income, and Hess Midstream. It's hard for me to pull Hess off of the list. Let me see what it did today. It dropped 1.37%. It's trading at around $41. So it's just been a really, really good stock for my portfolio. So if you're looking for income, Hess is not a bad way to get that. There is one other thing I would share with you. I'm going to add the holds to this. Novo Nordisk rates pretty high, but again, I'm not really wild about those companies. They kind of, they tend to be very trendy companies. But here's the one I wanted to talk about. Lamb Weston has jumped back up into third place on my model. I have it as a hold. I own about 2.5% of the portfolio in it. It went down today about 3.5%. It is trading in a $50 range. And if I were to kind of sneak over here, look at the percentage of fair value, it's trading almost 40% at a 40% discount. I'm going to sort this smallest to largest. It is the lowest fair value, percentage of fair value. It is trading at the worst percentage of fair value of any of the stocks that I track, any of the 101 stocks. So I don't know, man. It's $50 for Lamb Weston. I don't like their management team, and I don't like their strategy. But other than that, they're great. Now their execution risk is really high, and I wish I'd known that before I bought them, and so I'm down pretty good on them. But maybe it's time to buy a few shares and kind of average down a little bit, because I think our possible wins here are if the board changes out, the high management team, or if they have a takeover. I think those are our short-term possibilities. I think maybe long-term they can do something if they get the right people in. But I don't know. What do you guys think about Lamb Weston? Should I buy more of that or just leave it alone? I'll let you guys respond to that. Let's see. Where was I? Okay, Russ bought more of the Comfort Systems Fix, FIX. That's cool. My new favorite dividend, mega growth stock, super low starting yield, but the 19 forward PE is very fair. Yeah, there you go. You just like the fries. That is true, John. I do like fries. But I'm trying to stay away from them, but sometimes you just got to do what you got to do, man. Sweet potato fries. Hey, let me tell you what. Sweet potato fries are really good, but I will say this: if you get like a horseradish sauce, they call it, look for it, in the condiment aisle. It's not horseradish; it's a horseradish sauce. If you get that and kind of marry that, kind of like ketchup with French fries, it's this horseradish sauce with sweet potato fries. I think you'll find a new combination that is really, really good. I love it. Yeah, Lamb Weston. So I don't know. What do you guys think? Should I? Should I not? Russ says he sold a Nexstar Media $180 covered call expiring on March 21st for $135 and bought another share of Nike at $79.75 this morning. Man, that's great. So he sold a covered call, and so what has Nexstar Media been doing? I don't track that one. Let me see if I can find just a little info. Nexstar Media Group. Yeah, they've been trading pretty flat, it looks like, for the last few years, actually. Here, let me narrow this down. Here, I'll show you guys what I'm looking at. Just looking at fast graphs here. And, their earnings have gone all over the place. Up, down, up, down, up, down. Let me narrow this down to like 10. Yeah, they've been pretty flat, man. Pretty flat. So that, from my perspective, covered calls or cash secured puts work well when the market doesn't move very much. Those are the opportunities you have for those, because let's say you sell a covered call. If it goes above your strike price, you lose your shares and you lose out on any gain. If the stock price goes down tremendously, then you get the covered call income, but you get to also keep the losses. And I know there's ways that you can mitigate the risk by rolling it out and stuff like that. But just if you just look at the single transaction, there's a lot of risk on the downside. There's opportunity cost on the upside. So you want it to be in a band, right? You want it to be to stay pretty flat. I think doing covered calls on Nexstar is not a bad idea, because it has stayed pretty consistent for quite a while. So yeah, I think that works. I think that works. Let's see. Yeah, that's a good thought, Rust. Rather buy a higher quality stock on this dip than LW. Yep. Yeah, I hear you, man. It is just really hard to pass up something so cheap. But it's not about buying cheap, it's about buying value, right? It's had a bit of a jump. So this is Nexstar again. Bit of a jump. Yeah, I see that. Yeah. It looks 169. Yeah, so it's jumped up probably, man, like $20. So good deal. Yeah, so if it goes to 180, what are your what's your average for your Nexstar Media? 135. $135. Yeah, so what's your average cost on those, Russ? Is it much lower than 180? If so, that's not a bad deal if you're wanting to get out of it. Oh, political ad revenue. That's weird. I find that interesting because we know that there in every 4 years there's going to be this political ad revenue. So I don't know why investors are shocked, and like, oh man, I got to go buy some of those shares when it's just a very consistent thing. So anyway, we knew about the tariffs too, but it didn't help. So let's see here. All right. Okay. Oh, wow. That's fantastic, man. Average just under 138. So yeah, even if you sell this, you're going to get, have a nice gain, even if they get called out from you. So that's fantastic. Let's see. That's adjusted factoring in dividends plus option premium. Oh, I gotcha. Yeah. Ad revenue hits every 2 years. Yeah, you're right. I forget about the midterms. So, yeah, I hear you. I tend not to adjust my cost basis on option premiums. I don't trade a lot of options, but to me, an option premium is income, and it has nothing to do with the underlying stock. But I know a lot of people that do exactly what you're doing. Just because I don't do it doesn't mean you shouldn't. So, but I just thought I would throw that out as as another opinion. GIS is cool. So John Jay is asking about Hormel and General Mills. I used to own General Mills, and they just don't have enough growth for me. Hormel's the same way; they don't have enough growth. I think they're good from a safe perspective, and safe from everybody's gonna eat food, right? So you're gonna have demand for those products, but it's just not something that I wanted to stay in. So I got out of General Mills. Never did own Hormel. So Russ says that Hershey did good today. Let's see how Hershey did. The Hershey Company. Yeah, they were up 2.5%. Fantastic. I'll take that. I own a few shares of Hershey, about 2.9% of the portfolio. I think that from a long-term perspective, oh, I'm sorry, I was looking at the wrong one. went up 3.35%. So I think from a long-term perspective, Hershey's going to be good. And I think they historically have traded at a premium. And right now, according to my info, they're trading at a 15% discount. So I'll take that. And what's their price? 170. Wow, they've come back up. They were down in the 140s for a while. So yeah, 178. What do I have in the Hershey Company? Yeah, my price is 183. They're trading around 178. So I'm still down about 2.8% on Hershey, but I'm okay with that. I'm going to keep them for a long, long time. Obviously, unless something happens. But yeah. Anyway, so guys, we are at near the hour. So John Jay says they say Hershey is overvalued. Why? I don't know who they is, and I don't know how they can say that. I think it's undervalued. Anyway, I don't know. I don't know who they is. Maybe if you can shoot me a note and let me know who they is, I can kind of look into it, why they say that. But the info I'm looking at shows Hershey as undervalued by about 15%. It's not tremendous, but it's they historically have traded well above fair value, in my opinion, Anyway, with that, guys, I'm going to let you go. Thanks, Rust, for reminding about the Discord. If you're interested in the Discord, it's free to sign up. There's a link in the notes to this. So with that, guys, I'm going to get off here. I will let you get back to whatever you're doing on this fine Monday evening. And I hope you guys have a great week. And I will see you on the next one.